we are going to go ahead and get started. My name is Hope Anderson. I am the COO and Head of Client Success at Digibox. And today I have with me on the Zoom screen, Nicholas Merten, founder and CEO of Digibox, as well as the founder and CEO of DataDash, one of the largest cryptocurrency YouTube channels in the world. And today we're going to be talking about hyperinflation, kind of what it is, how it affects the everyday person, and some just different thought processes and strategies for how to hedge against it in general. So, and then right after that, we're going to be doing a live Q&A. So if you guys have your questions now, feel free to go to the bottom of your Zoom screen. There should be a little button that says Q&A. If you click on that, you can put your question in there. Please put your question in the Q&A box and not just the chat, because that will ensure that I find and ask your question for you. Otherwise, it could very easily get lost in the chat. So please put it in the Q&A box if you have a question. Feel free to keep talking in the chat if you guys would like to. Yeah, and that's pretty much it for housekeeping and general announcements. We're recording this. We'll try to put it on YouTube in the next few days or early next week. And then we'll have some short snippets of it probably available on our YouTube channel as well for later if you have to jump off early or you happen to miss something, or for those of you who are watching this later, welcome. So everybody, welcome to the webinar, and I'll let Nick take it away.
Awesome. Thank you, Hope. I appreciate you all joining in for the webinar. I think this is going to be a really exciting conversation to talk about this discussion around hyperinflation. I think it's been all the buzz and a lot of headlines for major media outlets and mainstream media pieces. So I want to go ahead. I'm going to share my screen here real quick and get started into it. Appreciate you all taking the time to join in. Just want to confirm, is the screen showing up good? Awesome. All right, guys, let's dive into it. So I want to go ahead and first, before we dive into some examples of real world hyperinflation and getting a very deep and intricate understanding of hyperinflation, not only understand on a surface level what hyperinflation is to start, and also understand the steps that lead to hyperinflation. It doesn't happen overnight. So we need to understand what signs to look out for to make sure whether or not we are entering into hyperinflation. It's the big question that's on everyone's mind. So first off, what is hyperinflation? You know, it's interesting. There's no real fixed definition of what hyperinflation is. But generally speaking, hyperinflation is talking or referencing towards a high inflationary pressure on the cost of goods and services. So for example, you're going to the store, you're buying your average everyday groceries that you buy for yourself or your family. You're going to engage in purchasing some kind of service or product, maybe your insurance costs or your healthcare costs. You notice that there's a large substantial increase in them. This is what we generally refer to as inflation, the increase in the cost of goods and services. And it usually stems from the creation, not just of inefficiencies in the system, but really the increase in the money supply. So when banks, or more specifically central banks like the Federal Reserve, print large quantities of money, and along with that as well, make the creation of credit in the system, the ability to take out loans or borrow from a commercial bank, readily accessible and cheaper to borrow, that increases the circulating money supply. And with an increase in the money supply, we tend to see an increase in inflation. Now, that's generally what inflation is. Hyperinflation is inflation on steroids, to put it simply. When we start to get rates of hyperinflation, of inflation, for example, being around 25, 50, 100%, or if not more than that, now we're starting to talk about hyperinflationary territory, where your savings at a bank account begin to dwindle in purchasing power. What was originally your life savings that could have helped you plan for retirement and live a fruitful life now may not be enough to get you through the next year or next couple of years. It can really start to decimate your purchasing power. So there's lots of definitions here about hyperinflation. The general thesis here is that we're talking about a reduction of pretty much 50% of the purchasing power of your currency. And we're going to be talking about how there are not only a lot of historical accounts of hyperinflation, but we're also going to be talking about here today how hyperinflation is in the real world today, not just in a variety of countries across the world and maybe more volatile regions of the world, more unstable parts of the world, but right at our doorstep potentially here in the next coming years in countries like the United States, in countries throughout Europe like Germany. Many countries could be susceptible to hyperinflation. So let's go ahead and talk about the concept in further detail. Let's go ahead and get to the substance here. So I want to go ahead and first talk about the first sign or the first part of the setup for hyperinflation. The first thing we're going to generally have here in the sense of hyperinflation is a macro event. Hyperinflation generally doesn't come out of nowhere. Hyperinflation stems from an increase in the money supply. But why would people generally increase the money supply? Is it just that they just want to print money in this case and make everyone, millionaires? Well, unfortunately, we can't just print our way towards making everyone millionaires. And most people generally understand that this is not a reasonable approach to increasing wealth or prosperity. In this event, when we see money printing, we usually have a macro event. This is a very fancy term for some major event on a nationwide scale that impacts practically all citizens, if not many countries across the world. So this could be, for example, war, as we'll talk about later on. And a lot of countries and a lot of pretty much empires, in a sense, if you will, some of the largest economies of the world back in the early 1900s had funneled capital into the war and needed to print large sums of money in order to finance that war. And that leads us towards a variety of issues towards like hyperinflation, for example, which we'll talk about later. There's also things like political unrest, distrust in the government's management, people losing faith in the underlying currency of that nation state. There's all types of different things. But one of the big ones we've got highlighted here is a pandemic, a macro event that completely freezes the economy and puts us into a state where we need to react swiftly to keep money flowing through the system. And that's exactly what we witnessed back in March of 2020, back a little over a year and a half ago. A macro event the size of which we'd never seen in the 21st century that really started to change the way we operate as an economy and froze global business and capital flow that put us in a state where we needed immediate response. Well, that leads us towards step number two here, the government's response. Now, I know people have mixed reactions when we're talking about government response, whether or not government is the solution or not, but overall, people can argue on both sides, right? When we had our issue here, the pandemic that had, shaped the economy in a pretty dramatic way, governments are going to do as much as they can to respond to the situation, whether it be for better or for worse. They're going to use every means capable in order to stabilize things, generally to the best of their ability. Now, there are really two types of government response that we need to understand about. There's fiscal policy and there's monetary policy. So I'll give a couple examples of each. If we think about fiscal policy, this is policy that the federal government can enact in order to help ease the economy. And it comes in many ways, but in the sense of playing into hyperinflation, it comes through things like we saw, like the stimulus check. Many people in the United States and many other countries across the world saw some form of government stimulus or unemployment benefits exacerbated from the previous existing programs in order to supplement income so people could still buy their everyday expenses like groceries, pay for their rent, get by in this case in order to cover the bare minimum expenses so they can get through these tough times in the economy. That's an example of fiscal policy, and also government spending, bailing out companies or providing financing towards various companies who might have gotten hit during the pandemic or this macro event. Would be a great example of fiscal policy. It's the government utilizing its budget or money that it's borrowing by issuing US treasuries in order to finance its expenditures. Right? Now, there's a second one that plays just as importantly, if not more than fiscal policy, is monetary policy. And this is not where per se the federal government in the sense of the Congress gets to determine, or most legislative bodies in most countries across the world really get to determine. This is something that the central banks of the world get to determine. So this is tools like money printing, lowering interest rates, basically managing the key monetary tools that make the cost of capital either more expensive or cheaper. They usually lower interest rates due to the general assumption that it stimulates the economy. People will debate about this, but that's generally what central bankers state that they believe. And outside of that as well, that money printing. This is one of the time-tested tools that central banks utilize to get the blood of the economy flowing again, right? When we had, again, the pandemic and everything had stopped, banks stopped lending to one another. There was this major freeze up in the economy. Banks were processing loans to consumers. And along with that as well, just money that generally flows naturally through the economy had stopped. right? Businesses shut down, revenue generation stopped for those businesses. So what's the immediate thing they're going to do? They want to keep the blood flowing. They want to put more money to the economy. So they printed 25% more money than what had existed beforehand. Basically, if you think about it this way, for every $100 in the economy, we created 25 new dollars in this case. A 25% increase in the monetary supply in 1 year, the largest increase in the history of the United States. And this happened in a similar fashion throughout the Eurozone, throughout Europe. It happened in a variety of other countries. It happened in Canada, Japan, China, a lot of regions of the world excessively printed large amounts of money in order to substantiate the economy at the time. So this is that governmental response, right? The injection of new money, lowering the cost to borrow capital, and also stimulus through fiscal policy, right? These are the general tools. So there's other tools that we didn't discuss here, but these are the major ones. Now, if we just inject a lot of money into the system, right? Sounds like a great plan. Everyone's got more money than before. Well, the problem from that point on is that prices of goods and services, as well as various other things throughout the world, are going to go up. The cost of all these different things that we know about in the real world that are fixed, that can't be printed into thin air, that have a cost to manufacture them or have some form of real world value, they're going to adjust to this inflation, not overnight, but soon after. And when I talk about soon after, it could be a couple of days, weeks, months, or years, but they start to reflect the reality of how much new money is in the system. And this is where we talk about the third phase, right? The third phase is the response from all of this money printing, lowering interest rates, and stimulus. We see here that as time progresses, the reaction from three major categories are as follows. We have the price, goods, services, generally going up over time, adapting to that inflation, right? We have asset prices increasing over time. So as many of you know, we're focused on cryptocurrencies here at Digifox. So if you've been buying Bitcoin, Ethereum, or a variety of other assets that we support here, or you've just been keeping up with the stock market, all these different assets, they're going up as well, reaching new all-time highs. Why? Because they're adapting to the inflationary pressures of new money being created in the system, right? If, for example, Microsoft stock has some form of fundamental value as well as Bitcoin. They have some degree of limitation in supply and real world value. If you inject new money into the system and people have more money to spend or invest, it's going to reflect in higher asset prices because they'll buy up those additional assets in order to protect themselves against inflation, right? Because these are limited to some degree. And then we have the third key sign here that we could see here when a currency hyperinflates, which is foreign exchange pairs. And basically seeing how, for example, if we take an example we'll talk about later, the Venezuelan bolivar lost dramatic purchasing power to the dollar. Now, this chart can play either way. If you're looking at it in the sense of the Venezuelan bolivar divided by the US dollar, right? How much the Venezuelan bolivar can purchase US dollars, you would start to see that chart decline. But if you saw the US dollar divided by the Venezuelan bolivar, you'd start to see it increase dramatically, showcasing that with $1 US, you can purchase more and more Venezuelan bolivars as the currency is losing purchasing power and value, right? So again, this is what you would generally see in a hyperinflation environment, much more kind of dramatic, parabolic, exponential moves in the price of goods and services, price of assets, and then also a decrease in the overall purchasing power of currencies. So I want to go ahead and talk a little bit about the Weimar Republic. This is one of the most common examples that people talk about when they discuss that hyperinflation is in Germany. And back during the early 1900s, this was one of the first real world examples of what hyperinflation actually looked like. And some of these photos, I mean, they say that basically a photo speaks 1,000 words. And I think these photos tell it all. When you get towards a state where you've printed so much money, as we'll take a look at some of these statistics later on, you start to see in the real world where this pile of cash that needed to be brought in on a wheelbarrow or needed to be stacked up in piles to just simply buy everyday goods and services showcases the depreciation of the currency. The currency, simply put, is not worth the paper that it's printed on, the paper and the ink that's used to print the money. is worth more than the actual underlying currency. That's a very good visual sign of hyperinflation. We've got some other pictures here. Again, some of these are just absolutely stunning. Seeing the cost of goods, you would generally think, when you buy a good or service in the United States or in the Eurozone, if you're a person with euros, or the Canadian dollar, or the Australian dollar, major economies across the world, you think about buying, maybe if you're buying a chicken, right? You're going to be paying a couple bucks or a couple euros in order to purchase it, right? A couple dollars, nothing too crazy. Well, the marks in this case, the currency in the Weimar Republic had gone up exponentially. And it's important to understand why you want to avoid hyperinflation so badly, because this event right here was one of the economic milestones in Germany's history that inevitably led towards Hitler's rise in World War II. So hyperinflation not only is devastating for the savers of the general economy, but it can leave macro side effects later on that lead people towards taking on dramatic responses, because there's a need to take dramatic responses towards this excessive monetary printing, right? So again, just a really interesting bit on history here. Again, another really exciting, or not per se exciting, but just mind-blowing photo, a full room to the brink loaded up with dollar bills, right? Absolutely incredible stuff. Now, this is a really interesting chart to showcase just how quick hyperinflation can kick in. See here back in 1918, the value of one gold mark in paper marks. So gold as an asset is time tested. It's been around for a long time. And we know that the history of gold is relatively predictable in the sense of its real fundamental value, because each year there's only about 1% to 2% new introduction of supply of gold. Basically, for let's say there was only 100 ounces of gold in the world. Every year we find and mint and refine about 1 to 2 new ounces, right? Relatively predictable inflation in the underlying supply of gold, right? But in the sense of the paper marks, paper is unlimited, right? We've got trees all across the world. We can make the ink to print the actual currency for the mark. And we can see here that, again, hyperinflation, as the government was starting to print large amounts in order to finance the war and to be able to cover expenditures. We could see here that the actual paper marks inflated so greatly that one gold mark in the Weimar Republic, in 1920 would give you 10 paper marks. Just a few years later, 3 years later, that experiment led it towards 1 billion marks. Apologies, my math on that's wrong. 1 trillion marks per one gold mark. Again, that's at the point when you start reaching this parabolic curve. That's the later stages and the deadly phases of hyperinflation. At that point, any money you have in savings, any money you've put under your mattress or in the bank account to get yield, at that point, it's practically worthless. You might as well use it as toilet paper, to put it frank, right? So this is a very serious matter, guys, to talk about. And I don't want to scare you guys overall with hyperinflation. We'll talk about some real world economies here that are going through it, but also keep the open reality that this could be very well the case for the United States and many other countries across the world. No one is impervious to hyperinflation. So let's talk about Venezuela here. Now, Venezuela overall met towards all three of the steps in order to get to hyperinflation. The first two key ones, which were instability, right, as we talked about here in our drawing. As we go up here, it's usually caused by war, pandemic, political unrest. In the case of Venezuela, this was political unrest, right? So in Venezuela, they had their issue. The response of Nicolas Maduro and the general Venezuelan government was to print more money in order to cover themselves through a crisis that they were going through. There's a lot of reasons people argue that caused it. I think it had a lot to do with political dissent and distrust. It had to do with the oil price crashing, which was a large part of Venezuela's economy. And again, like many governments in the past, Venezuela took the route of printing large sums of their native currency, the Venezuelan bolivar. Now, I want to go ahead and showcase some really shocking photos, because these are not black and white photos. This is present day stuff that happened just back a couple years ago. Here's a picture of a normal chicken, right? Many of us take it for granted. We can go get a chicken or turkey at the local food market. Heck, you might eat it every single night, right? And what we see here is the amount of money at the time this photo was taken of Venezuelan bolivars that would be required to exchange to a merchant a grocery store in order to purchase this one chicken. Amazing. This amount of money originally, back just a couple months or a year or two out, could have been someone's life savings. But now, in order to get something that really is seen today as common good, is now seen as this luxury that barely anyone can afford because the currency has been depreciated so much, right? Let's take a look here as well at a photo you might see in the article, right? To just get a basket or a couple handful of tomatoes, stacks upon stacks of cash, right? So these are the visual signs here when you start needing more money, whether it be electronic payments through your debit card or through cash settlement, in this case, hand to hand. Either way, the cost of goods and services are, starting to double or triple from the original value. Those are those early warning signs that something big is around the corner. And the problem with hyperinflation here, right? If it weren't bad enough that the government starts printing money, hyperinflation, the actual increase in the price of goods and services gets exacerbated because you have the initial stages here, the initial signs where you start to see prices start to double or triple due to these inflationary pressures. And we've seen this year, the highest inflation we've seen in decades. I think the highest rate since 1990, very similar levels as we're growing here towards what we saw back in the 70s and 80s in the United States. We get this general distrust in the currency, and that exacerbates the increase in the price of goods and services, even when governments aren't printing money to those levels, right? So people start saying, you know what, I'm really not sure what the inflation rate is going to be, so I'm going to start marking up my prices. And people claim that this is merchants or companies trying to price gouge. No, this is just a general response here because they have to protect themselves. They have to maintain profitability as a company or they'll go bankrupt. So they have to anticipate these next moves from the government. It all stems from the mismanagement of monetary policy. We can't blame merchants for this, right? So again, big misconception here. It always stems from monetary policy. And we can see the price of a cup of coffee in Venezuela going from just a couple bolivars, right? Probably double digits, all the way up here to 3,000 bolivars in mid-2019. Absolutely crazy stuff. So this is, again, a chart here of the inflation rate on an annualized basis in Venezuela. You can already see, again, that topic we talked about here, the warning signs early ahead. Generally, Venezuela had already been relatively unstable to some degree, had a relatively decent rate of inflation each year, double-digit annualized inflation, right? It doesn't happen overnight. But then you see here, the sign here, the warning signs, 121% here, and I think it was in 2017 or 2018, right? Early warning signs coming about a year or two out before the major hyperinflation kicks in. And now the important thing is you see this drop here. This doesn't mean that the inflation per se dropped, but the inflation rate, right? So we had a 65,000% increase in the inflation rate in Venezuela. We had 19,906% increase afterwards, a 2,355% increase afterwards, and it's remained relatively high and around that range to where it's at the point where merchants, I've had, for example, my partner, my girlfriend, she's actually visited Venezuela, and she would go to the merchant to see, what was the cost to get a bit of ice cream in the local town square. And a week later, she came back and the prices had already changed. They'd already adapted to this hyperinflationary environment. So it's absolutely crazy stuff. Now, it's not just throughout regions in Latin America like Venezuela that are experiencing these issues. Again, the issue knows no borders. Turkey, for example, right? As we step into the bridge between Europe and Asia, Turkey was in a really bad spot here over the last couple of years. Turkey had for its issue here, in the macro event, they had borrowed a lot of money denominated in US dollars, right? So they had started to borrow a lot of money to finance government expenditures, to cover general expenses. And the problem that Turkey didn't realize when they were financing this debt and expenditures is it was denominated in US dollars. This basically means that the loans were needed to be not only paid back in the sense of the principal, like the original loan. Let's say you borrowed $1 million, to finance expenditures. They not only needed to pay back $1 million, but they needed to pay interest back in US dollars. So when they're actually spending this money in the economy, it's going to be in Turkish liras. And the problem with this, right, was that the Turkish lira had already started to deviate from the dollar. So as the Turkish lira was losing purchasing power against the US dollar. This means they needed to get even more Turkish lira in order to pay down the original US dollar denominated debt, because they're eventually going to have to convert it to dollars to pay down the debt. And this became an absolute nightmare for Turkey, because what happens is, in order to pay back those debts that were due and pay back the interest debt on the debt, they needed to print more money. So this devalued the currency even more and led them into a spiral here, right? Where originally each US dollar, for example, you would generally, for per 1 US dollar, you could get probably about 1.8 to 2 liras. Now you can get up to 9, potentially 10 Turkish liras just a couple years later, just a decade later here. So I want to go ahead and put this in perspective here and why this is so important. You think about it here, where someone had worked multiple decades to save up for their retirement, for their future, to go on a vacation that was well-deserved, save for their kids' future. And in a matter of a decade, those savings have lost nearly around 80 to 90% of their purchasing power. They can barely probably get you through the next 2 or 3 years, if anything. That's incredibly scary to think about, isn't it? That a government or central bank, or a combination of both, those in power, have the ability to either secure your financial future or take it from you, whether they intend to or not. Right? This isn't a game of talking about whether or not governments are the solution to problems, or the old famous quote of government isn't the solution to our problems, government is the problem, right? We can debate about those narratives all we want. What we need to talk about, though, is that hyperinflation is real, that the vast majority of fiat currencies, dollars, euros, all these currencies that we know about, where we store a lot of our wealth in savings accounts or under our mattress, they inevitably, historically speaking, generally go to zero. And there's generally resets where new currencies are issued and the whole game of the economy restarts. It's not crazy to think that we could see this in the 21st century. Now, I want to go ahead and talk a little bit about the domino effect of hyperinflation, because people think, okay, look, Nick, I hate to say it, hyperinflation is a terrible thing, but is it in my neck of the woods? Is it in my country anytime soon? Well, I would go ahead and make it very clear here that you're going to see hyperinflation, as we already have started to see, in a variety of countries that are generally unstable, that have more corrupt governments, unstable economies, that are very commodity driven. So for example, their economy is generally driven, their GDP more specifically is driven by commodity output and exports. So specifically export economies, right? And then second off, it's going to work its way up slowly, more likely over time, towards larger economies. So one thing that I do want to emphasize here, and this is a really good measurement that you guys can utilize, it's called the US Dollar Currency Index. It's an index of how the US dollar is performing against other global currencies, right? So when the DXY or the DXY is moving upwards over time, that means the dollar is garnering strength against other fiat currencies. Now, one important thing to note here with this index, it doesn't mean the US dollar is not losing purchasing power, right? Over time, all fiat currencies lose purchasing power because there's the introduction of new money, right? So again, having your money in dollars is one of the worst places you can have it in, at least in today's environment, right? So again, I digress on that. Unless you're getting some kind of yield on it, that's an important point. So we have, for example, Celsius within Digifox, where you can get 10% yield on your stablecoins. But I digress on it. What we can see here is that over the past, really over the last more than the past decade here, we can see that the US dollar has been gaining against other global currencies across the world on average, against most currencies, whether it be in emerging economies in Southeast Asia and Latin America, but also as well in various jurisdictions like Canada, Australia, Japan, the euro, in this case, the Great British Pound. US dollar has generally shown a lot of strength over the long term. And over the past couple of months, really, since back here in May, in June of 2021, the dollar has been garnering a pretty decent degree of strength against most global currencies. It's been recovering back after having a decline since back here in March of 2020, as the US was one of the first countries to make a major immediate response towards the pandemic and funneling the economy with cash, right? So again, it started to regarner that strength. So it showcases here that the rest of the world may be in a worse off position than some of the more established economies. And this has a lot to do with the dependency and the power of the dollar across the world. It's a topic for another time. But overall, general thesis here is that if you're in the United States, hyperinflation probably isn't coming to your door in the next year or two. But it is potentially likely over the next couple of years if we don't turn the course on monetary policy, if we don't pump the brake and stop all of this crazy fugazi or kind of make-believe world that we can just continue printing money out of thin air in order to solve our problems. And the central bank has used every means possible at this point, practically all means, in order to do that. And all they can do is continue to exacerbate that by printing more money, potentially lowering interest rates into negative territory, which would be disastrous for the economy. This is what's been going on in a lot of countries throughout Europe, and has really started to freeze the banking sector overall from being able to process as many loans as it should. So as we dove into here, guys, this can be a pretty grim topic. Again, I don't want to downplay it because it's one of the biggest fears we need to be concerned about, especially when we're seeing heightened levels of inflation. But I believe we've historically seen countries take the necessary responses. And to talk about that, to summarize it, the idea would be to increase inflation rates. We saw this with Volcker, who was the Fed chairman back during the hyperinflation or the higher rates of inflation we'd seen in history back in the United States. It would be to raise inflation rates, stop the printing of money, go through a small window of time of hardship in the economy, and let things start to work themselves out and reintroduce a stable rate monetary policy. That's what most people would argue. But it's a topic where people have so many different opinions. Some people are now arguing in the media that inflation is good for you. I will go ahead and say it very clearly, guys. This is not just an opinion piece. Inflation is not good if you're the common man. If you're the common everyday individual, it's not a good thing. It is the maker or breaker that leads towards inequality in the economy. We can see during periods of high inflation and money printing, asset prices move up. Who owns assets? Well, in the United States, for example, I think it's the top 1% own about 50% of all assets in existence. That's every property, every stock, every bond. They own 50% of the entire asset market. And inflation only benefits assets because at the end of the day, if you've got your money, like the I think it's 9.5, $10 trillion in deposits in the US, banks not paying any interest. So you're getting your purchasing power eaten alive every single year. So anyways, sorry to be so passionate or ramble on about it, but I think it's a very interesting topic for sure.
I think so too. Like thank you, first of all. It was a very, very informative webinar. We'll go on to the Q&A section in a minute, but like, it's just, I was going to ask you if you could kind of just very quickly designate, like, is there a set definition between the difference between inflation and hyperinflation? Because they sound a lot the same, but is it just that hyperinflation is just like an exorbitant, like a huge amount of inflation?
Exactly.
Okay.
Yeah, that's why it's a bit subjective, like the label definition of hyperinflation. But I would say the difference between inflation and hyperinflation is, whereas inflation, I would say we're still in an inflationary environment right now. Yeah. Even though it's higher than usual, it's usually anywhere from around the reported numbers of 2 to 5%. I always believe the numbers are a bit higher. They generally will find ways to kind of fudge it and understate it. So I think right now we're experiencing more like 10, 12% inflation realistically. Whereas the numbers being reported about 5 to 6%, so about double if we really think about the cost of living and housing. Mm-hmm. But hyperinflation is when we really maintain, reported numbers recording like double-digit territory, like 20, 30%. And those are the early warning signs. Then after that, we really get into a phase where we're talking about triple-digit, where something that you bought for $10 a year ago is now going for 20, 30 bucks. And really things are starting to spiral out of control. People start losing trust in the government and the central bank's capabilities to be able to stabilize the situation. And then people's mindset, the merchants basically exacerbated from that point on.
Yeah, definitely. And you were talking about like what needs to change in order to fix this and make it better. But a lot of people, I feel like I was listening to this and thinking to myself, especially like, well, that's great, but I'm not in politics. I can't like change the monetary policy. Is this kind of like a call to be more involved in your local government and your government in general and elections if you have the privilege to be able to do that?
Yeah, I think it's two things. So you got to think about what you can do for the general good. But I always say this, I think it's the rational thing as a human. And outside of that as well, it's the first priority, right? If you want to help out others, you first got to help yourself. You got to make sure you're in a good position. It doesn't mean you need to always think about yourself at every cost, but you need to make sure you have a good base foundation. Your family's protected, that your financial future is secured. And I think the first way to go about doing that is to make sure that you have some decent exposure to assets, because assets are time tested, whether that is commodities like gold and silver, whether that's cryptocurrencies like Bitcoin or Ethereum or Litecoin, or investing in the stock market. Having a diverse portfolio of assets that can provide you that protection if people lose faith in the underlying currency. That's very important. It's also important to have some money in cash in hand, as well as money in your bank. I believe that's very important as well. I'm not a 100% asset investor in this case. I do believe it's important to have some money because asset markets can go through dramatic corrections once monetary policy stabilizes. But to your point as well, Hope, yes, there is outside of protecting yourself, there's also a call to action where you should speak out about it. Inform your family and friends, invite them to webinars like this where people can learn about it so they can not only protect themselves, but also they can speak out to their politicians, their representatives, and be able to leave some kind of impact. I think we understate it, but when we move as a movement, as people, and we speak out about it, it can really start to move the needle.
Yeah, it's definitely something where if you have a bunch of people thinking about it and talking about it and writing about it and teaching their children that, like, that's where things change. And not like I'm not really a big believer in like electing, like in putting all our hope in like a politician.
Right.
I'm more of the opinion of like you gotta really educate the masses of the problem, and then eventually new leaders will rise up, hopefully from the masses of people that you've educated, and especially the children, the kids. Like kids aren't too young. Like a lot of like middle schoolers even aren't too young to understand this. It seems like a pretty complicated topic, but it's not really when you really just break it down. So,
and I don't know if it's telling. I'm assuming this is seen as a bad thing, but there are many politicians across the globe. There are no borders when it comes to this, who unfortunately don't get a concept in middle school or high school or shouldn't understand, and that is very scary when it comes to our personal savings and our net worth. So we definitely got to get the word out in that case.
Definitely. So feel free to share this webinar if you find it useful and you think that it's speaks truth. And obviously we don't offer financial advice, but this is just our attempt to be educational and help spread topics that we are passionate about, especially because of the company that we have, so Digifox. And this kind of ties a lot into Get Paid in Crypto and why we're launching that feature, to be able to have people have like a regular way to invest in crypto, do dollar cost averaging, to hedge a little bit against inflation, and continue to do that without having to think about it. So that's a huge reason why we're launching that feature. We have a lot of questions, so we can kind of get into this one. You sort of answered during the presentation, but CJ says, "Hey Nick, could the U.S. dollar actually go the way of Lebanon or Venezuela?"
Yeah, this is this is a very big question, and I don't want to overstate anything, but I want to make it very clear. If we think about fiat currencies as a technology of storing and transferring wealth, that's really what money is, whether it's cash or digital money in a bank ledger that you use when you spend your debit card. I want people to remove all labels, all trust in that system, and think about it in a very simple way. That piece of paper, that number in a bank account, is no different than a Venezuelan bolivar. It's no different than the Turkish lira. And that's a very scary reality, which is that there is no difference. We might say that, Jerome Powell and the Federal Reserve, who manages monetary policy, and the federal government, which I think we already know in the US, generally Congress has a pretty low approval rating. these are the people who are dictating monetary policy. And they are going to play a major role in determining the value of the US dollar, as well as the euro and the Eurozone, the Canadian dollar, the Australian dollar. Any of these fiat currencies, they're all the same. They have different labels. They may be printed with different material. Either way, they can fall victim to the same issues. And you have the right macro event that happens. I think we had it with COVID here. Probably one of the biggest ones we've had in decades, bigger than any previous wars we fought in the sense of the impact on the economy and our government debt. This is the perfect storm here to really set us up for the foundation of it. So I don't think we're going to see hyperinflation in a year or so, but it's something we need to keep on our radar and look out for those early warning signs. If we get into double-digit inflation on an annualized basis for 1 or 2 years, there is a very heightened chance of it. If we don't see that, though, and we see the Federal Reserve take the necessary steps, then it's least likely to happen in the United States. Either way, the US would be one of the last candidates, having one of the strongest currencies in the world. I know I'm a US citizen, so I'm biased, but that's what most economists would say as well. So
yeah, and a lot of currencies are based off of the US dollar.
Yeah, exactly. Yeah, like in a lot of like emerging economies, people save or want access to US dollars in some way, because even though they're depreciating in value and inflating, it's much better than the localized currency that they're used to.
Yeah, and that's why it's especially important to hedge against inflation now, so that you don't get to the point where you see those early warning signs, and then it's not quite too late, but it's almost that way. So doing it now, just so that when it gets to that point, you don't have to worry, because I feel like moving to a different country is not an option for most people.
Yeah. And well, this is the cool thing of about get paid in crypto. Like, we're initially launching in the US. And the thing is that even though we're initially launching in the US, the idea is to go into Latin America, through Europe, the UK, Canada, Australia, and also in Southeast Asia. And what's so nice about crypto is, again, thinking about it as a technology, it differs from fiat currency. It has a fixed supply. These rules are programmed into the protocol, and anyone can review them. Anyone can see if they're modified, improved, or changed. And that's what's so cool, is that we have this transparent technology that the earlier you get that exposure and hedge yourself, the better. Even it doesn't matter, again, Bitcoin's in a bull market, bear market. The idea here is to protect yourself long term. If you're using crypto as a vehicle of savings for the next 10 years or so or more, crypto is going to easily protect against the purchasing power of just having your money in dollars. So this is the important thing to think about. Think about it in a long-term perspective, and don't worry about the volatility or what the headlines tell you and stuff. We know crypto is going to be an asset class here to stay for the next coming decades and centuries.
Yeah, this kind of is leading into the next question from Daniel, who says the gold and SPY ratio is hitting bottom band, 66% market decline, and gold stays the same, or 30% market decline, gold doubles, brings us back to neutral band. Still room for SPY to double, with gold staying the same before end of euphoria. Current momentum could lead to crash mid-end of year, with 2023, latest if gold and SPY sentiment stays the same. What's your expectation for gold bounce versus Bitcoin, which is hybrid risk on / risk off asset? Sorry, it's a long question. Huge fan for a long time, he says. He says you rock. Cheers.
Awesome.
But basically, I feel like what he's asking is kind of, and what I was just about to wonder was, you're talking a lot about hedging against inflation with crypto. What about gold and silver? What do you think about those two?
Yeah, so gold and silver look like, I think about it in kind of like a tiered ranking. I overall, any assets will be better than having your money in a savings account. Even just buying government bonds would be better than having your money in savings. But to this question of golds, it's not that I'm bearish on gold by any means. I think gold's going to start to play a little bit of catch up, and to that point, maybe start to even outpace equities over the coming year or so, the stock market, roughly speaking. But I think the important thing to understand, if we're speaking from historical performance, generally speaking, commodities and equities go through these major cycles. Right now, it has been more favorable to be in equities. It's just a known fact. Gold has been generally lagging over the past decade since it had its strong rally against equities. I can actually pull up a chart here. This is a great example of how you can utilize ratios in markets. So we've got exactly as the gentleman was referring to and stuff, we've got gold divided by SPY. So this is the basically a ratio of gold divided by the S&P 500. And what we can see here is that during the early 2000s, gold heavily outpaced the S&P 500. In fact, we can use a date and price range tool, right? Again, no one's ever generally buying at the bottom, but we can see from the lows here at the start of June in 2000, right, the year 2000, up towards August of 2011, gold outpaced the S&P 500 822%, a major rally over the course of multiple years. You can see this was 134 months. So we're talking from, again, mid 2000 to mid 2011, right? About 11 years cycle here. But ever since then, as equities have been in a bull market, gold has underpaced equities by about 77%, right? So again, until we start to see a clear trend reversal, I generally rank it as follows: crypto as the best hedge, as it's an emerging asset class. The second would be equities. The third would be gold and silver. And then the fourth would be bonds, or more specifically, US Treasuries. Is kind of the gold standard. So those are kind of my rankings in that case. But again, I think any smart investor has some decent exposure to all these assets. So all the while, gold and silver are not a large portion of my portfolio. I've got like some gold coins and silver coins that I've gotten either gifted or I've held on to and stuff and purchased long ago. So I think it's important, and that also goes for just being prepared for anything, having like, I know it's very like prepper mindset, but having like, again, some basic necessities around you and stuff, I think are always good. But yeah, that's the general thought process there, is that I would be more bullish on crypto and equities versus gold.
Yeah, just anything that the government doesn't have control over, basically.
yeah, anything that they can't just print to oblivion. Exactly. Gold has limitations. Equities, you can dilute equities, but the thing is, they're usually, the owners of their shares are going to determine whether or not they want to dilute them or not, and they usually don't want to dilute their shares because that dilutes their ownership. And then bonds, the government has to issue new bonds and have people who are willing to monetize that debt and basically craft those and buy those bonds, those IOUs from the government. So yeah, there's they at least have some limitations. Bitcoin, what's so great about it is that it's fixed. We know the monetary policy. So it's like the ultimate asset overall.
Yeah, we have a video on our YouTube channel, like the 6 characteristics of a good and reliable currency. So if you want to go watch that, I can find it after we're answering the next question and post it too. But we'll try to put it in the link in this YouTube video after we post it. But it talks through like what makes a currency like non-tamper proof and like that kind of thing. So we have a lot more questions, so I'm just gonna go to the next one. Joel says the US dollar index has been going up even after we signed the bill to print money. It hasn't gone down because the money hasn't been printed yet. That's his question? He's just wondering why it's been going up.
Yeah, it's a great question. So the important thing, as we talked about earlier, is that even though the dollar index, or the DXY or Dixie, I always like to say the acronym is almost like a word. So even though the dollar index is increasing in value, it basically doesn't mean that the dollar is increasing in value. It's generally a measure of how it's performing against other fiat currencies. So we have to understand, while the dollar, like the Federal Reserve, whether it's the government managing fiscal policy or the central banks managing monetary policy, either way, even if they're printing new money and creating new money and loans for the economy, other economies across the world might be doing the same, if not worse. They might be printing even more money. They might be lowering their interest rates even more than the US. And because of that, that allows the dollar to actually gain strength against those currencies. So the DXY, or dollar index, is just a pure measurement of how the dollar is competing against other currencies. All of them, though, the important thing to realize and not get confused about the Dixie is all of them are on a race down in value. They're all going down over time. That's historically proven with every fiat currency, and that's never going to change, because so long as governments and central banks can print that money and they don't keep a cap supply, it's always going to be diluted. It's always going to lose purchasing power. It might garner purchasing power against other fiat currencies, but again, by the general trend of increase in the money supply, you're always going to depreciate the purchasing power. Outside of that as well, the important thing as well is that even when governments might be printing money, sometimes those inflationary pressures will showcase months later. And I think we've kind of seen that now. We had all this money injection in the economy back in March of 2020, but we're really starting to feel the pain like a year out right here in 2021, between the spring of 2021, around March and April, to where we are now. It's starting to get really serious. So again, I would say that don't let the indexes fool you in that case. Sometimes they can change the perception, when in reality they're all on a race to zero.
Mm-hmm. Sure. We're going to keep moving because we have quite a few questions. Jan says, this is actually a really good question, something we kind of touched on just a minute ago, but is it not good to mention that some inflation is good and even necessary, as the opposite, deflation, may send the economy into recession?
Yeah, it's a good point. Yeah, so to kind of run through the base definition of inflation, inflation is the increase in the money supply, the general increase in prices of goods and services, usually paired with increase in the monetary supply. Deflation is where the cost of goods and services actually go down. Now, at first, this might sound like fine and dandy and stuff. And there's a going on debate about whether or not like inflation and deflation is good. Most economists will tell you that deflation is bad. And the reason why is that the theory goes in this case that if prices are going to go down, then people are just going to keep stockpiling cash, and they're not going to spend it in the economy. They're going to hoard money in this case and not spend it. And all the while, I think that is a fair point to bring up. I'll say this. We've obviously seen that in an inflationary environment, and we're talking, we need to be realistic. We're not at the ideal 2% inflation that the Fed has talked about or said that it's targeting. It's much higher than that. And also the numbers, I think, have been misstated for many years. In an inflationary environment where money's going into asset prices, this has left a major gap in wealth inequality in the U.S. And more than anything, again, even though it's a controversial topic, really the dismantling of the middle class in most countries. So we've seen that that's what an inflationary environment looks like. In a deflationary environment, those people who have $9.2 trillion in savings, who are probably just saving that money anyways, who are again passively saving for the future, those dollars now have more purchasing power. They can go out and buy more things. So that can help them buy their first home, make major life expenditures. I don't think the average consumer in today's world would really, first off, be very observatory on prices. If something went down 10, 20% in cost, I don't think they're going to start hoarding their money and waiting for a later date to buy things. So this is, again, something we really need to see more in practice, I think, and test it a bit deeper. I don't hold as negative of a take on deflation as most people or most economists traditionally do. But I think the ideal position here for a central bank would be to take a monetarist approach, which is basically the ideal 2% inflation every year. And if you're honest about that figure, if you're honest about trying to have that credit or that new money being brought towards productive activities, that's the most desirable outcome, in my opinion. If you were to keep a world of central bankers and governments, I would want to make sure that that money is going towards productive purposes. It's a much broader topic we can discuss, but the issue in the US and most Western economies is most new money is going towards credit and consumer spending, which isn't productive. We're just consuming, right? And taking on more debt. So I think we need to have it go towards more productive purposes. This is something that Richard Werner and a few other major economists are big promoters of. If you guys are really interested in these kind of topics, I recommend diving into it.
Thank you. And then, I can probably grab this one. Eduardo says, did Digifox have the same location restrictions as Celsius? I ask because I'm unable to get yield on USDC with Celsius. So some states don't allow you to earn yield, and Celsius can't support that. So if Celsius can't support it, then we also can't, because they're a partner of ours. We literally use their app. So if they can't support it, then we can't. That would be New York, Washington, Rhode Island, and Kentucky, I believe, at the moment. And then there's a few
Tennessee as well.
countries around. Oh, Tennessee as well. Okay, Tennessee as well. And then in Texas, stable coins are like USDC. Stable coins are not allowed for some reason. It's just part of like the laws of different states. And then there's different countries too where it's not allowed, or just Celsius has a restriction so that we can't service those countries either. But yeah, basically, hopefully that answers that question. So if you just check where you live, if Celsius doesn't support it, then we can't either for Celsius. But for like seed phrase wallets or anything like that, we can support that. So
one thing I was going to say as well, whether if you're in this position where you're kind of getting hit by the stablecoin regulation, it's overall it's a topic that's going to go on, and maybe things will change in the positive direction. We're a big fan of stablecoins and Celsius saving services, but we got to comply to regulators, right? One important thing that you can do right now is if you're not able to get yield in your stablecoins, what you can do is dollar cost average into crypto and utilize that as a wing of savings rather than keeping in dollar savings. Because what's great is that you have the two alternative positions. Either you could hold USDC or just dollars in a bank account. You're not going to get any yield due to regulatory restrictions in this manner, or you can hold crypto that has historically outpaced stablecoins. So again, not trying to push get paid in crypto too much, but I think again that idea of dollar cost averaging into crypto as a means of saving, I think is going to be something that will historically outperform not just keeping money in the bank, but even being able to get a yield on stablecoins of 10% annually. So we can see that with the historical performance of crypto. So just that's always an alternative as well.
Joel says, does it make more sense to work more and save more right now?
Yeah, I think overall it's never a bad time to save. There's not enough people in the economy saving. I know there's a lot of metrics that came out that said during the pandemic, people started saving more than usual. And that is true. People started to park money away. They weren't out spending it as much. And also the government was giving away a lot of free money. But the important thing here is that it's never a bad day to save. It's never a bad day to put aside money for a rainy day. And we talk about, here at Digifox and stuff like, we're not certified CFAs in this case. I don't want you guys to take it as pure financial advice, but the general thesis you're going to get from people is having a rainy day fund, having some money set aside for an emergency, right? We talk about these big things like hyperinflation, but more dramatic things that could hit you tomorrow are being able to cover for an emergency expenditure. Get a car accident, family emergency, you get laid off from your job. Those kind of things are much more real and tangible. Mm-hmm. So it's always a great time to save. But I would say on the broader perspective, if you're going to save money, the general thesis is you want to put it in assets that are going to go up in value. So I would say, speaking with my actions, I'm constantly investing as much as I can, but I also keep some cash on the side.
Yeah, because you can't really just, at the moment, you're not able to go to any local store and use Bitcoin or Ethereum or whatever most of the time to like buy groceries or whatever. So you always have to have some kind of a local currency on hand to be able to do that. And in terms of saving, it's in the United States right now anyway. Like if you just save and you don't have any strategy to it, and you save and you kind of get punished to save in this society right now, because if you put your money in a traditional bank, their interest rate is very low. It's less than 1%. So you're already losing based on inflation, correct? So
no, yeah, you're 100% right, Hope. I think like if you're going to save money, make sure you get that yields, right? And that's what we offer through our integration with Celsius. You can earn up to 10%, generally 8 to 10% annually. The rates will vary a little bit on your USDC savings. And I think that's the biggest thing. If you're going to save money and it's not going to be in an asset, then you have to make sure you get that yields, maximize your yield, make sure that whoever you're depositing your money with, they're working for you in that case to give you the best yield possible.
Yeah, because I feel like before I knew all this, I was like, oh, just put your money in the bank and save it. But if you let it sit there, it's just gonna lose its value. So you have to be proactive with it and figure out, like you said, how to get yield on it or put it into precious metals or crypto or something like that. So
absolutely. Yeah.
I might butcher this name, but Joseph says, at the beginning of inflationary depression, the stocks have a sell-off because the money escapes the country, trying to move out of the currency that loses its value. Example, Germany. Do you think that crypto will follow stocks at that moment as it follows it now? And could it recover soon afterwards? Because that could be an easy way for an escape of a depreciating currency.
Yeah, it's a good point. So from my understanding, and Joseph, it's not to disagree with you by any degree. I think you might be right in the case of the Weimar Republic. Sometimes we've actually seen asset prices have what's we usually call, we're familiar with the term a meltdown, right? When something just goes absolutely down and is a disaster situation. But actually, sometimes we find in hyperinflationary economies, and I think this happened in Venezuela, if I'm not mistaken, we had a melt up in equities. As we kind of drew earlier, this idea that asset prices will adjust to the inflation. People rush from the currency and anything else they can get into, not only physical commodities like gold and silver, into everyday consumer goods and services, but also into equities, stock market. So I would say that we very well might get a melt up in asset prices, not just U.S. equities, not just potentially any other type of assets like gold, commodities like gold and silver, but definitely cryptocurrencies. I think at a time where people are really starting to lose trust in the government's ability to be able to manage monetary policy, they're going to be going into assets in this case that allow you to store that value to some degree and hedge against government's control over the monetary currency. And as I hope you brought up a great point here earlier in the webinar, which is like, you can't still really, you can, there's a couple of debit card solutions where you can go out and spend crypto, but that's all selling it to fiat currency. So merchants still really aren't at that mainstream point of accepting crypto. Perhaps that could change though. When it gets to this point where hyperinflation is concerned, an employer who was like, we're not going to touch crypto to the 10-foot pole, gets to the point where inflationary pressures are 20, 30, 50%. We saw this in Venezuela. They started to accept cryptocurrency to some degree. And I think in a very tech savvy economy like the United States or Canada or Australia or the broader Eurozone, I think crypto adoption could really amplify during this time. So I wouldn't bet against crypto whatsoever. In fact, I'd want to be in crypto during that time period.
Mm-hmm. Yeah, and then Daniel asked this really interesting question that I asked him to put in the Q&A because he put it in the chat. And he says, why is government collecting taxes when they are printing what I suspect is a lot more new money out of just thin air? It's a good question.
So it's very interesting. I know recently we had posted on Twitter a reply to Eric Voorhees. He's a very big, I would say probably Austrian or libertarian in the cryptocurrency space. And he's very much against inflation. He sees inflation as a form of taxation, all these kind of topics and stuff. And I can generally agree with a lot of the perspectives and see his points. But the major topic here that people are like asking themselves when the government just prints all this money and the Federal Reserve says they have unlimited liquidity, unlimited money they can print, start to ask yourself, it's like, wait a minute, like, why am I getting taxed, right? And to be completely frank, people are asking the hypothetical question, could it be that we don't have taxes? We could absolutely have no taxes. But what's going to probably take its place, which will be just as bad, is going to be a very high degree of money printing and inflation, just like we saw this past year, where 25% of the existing monetary supply ever created was created in 1 year. So that's what it would look like in order to fund the government's deficit. The government would issue a larger rate of bonds, and basically the Federal Reserve would buy those bonds and in exchange give them cash in this case. And they already do this on a normal annualized basis every single year. It would just be on a heightened level. So you would have no taxes, but you would have to face the devalue in your savings and your purchasing power. And that's probably the biggest concern for people, is the cost of goods and services would go up dramatically in order to finance the current government expenditure. So we could technically do that. But again, it's important to note that it is another form of taxation. It's just not apparent to you. And that's coming through the devaluing of your purchasing power and also your salary. If your salary doesn't adapt to that increase in the money supply, you're losing, from your original salary in this case. So long story short, we technically could enter that. And some people have theorized and talked about that on an economics level. So we're going through some very experimental times.
Yeah. I mean, technically could. It's harder to hide what you're doing as a government if you don't tax people too, because then
Yeah.
you, like you said, you have to print more money then, and then it's a little more obvious what you're doing at
Yeah.
that
And
point.
no, and I forgot to mention, this is the really interesting point. Eugene had pointed this out on Digifox News, on the Digifox page. He was replying to Eric Voorhees, and he brought up a really interesting point, which is that by taxation, in this case, you force people to utilize the fiat currency in a sense. So by
Mhm.
effectively having a taxation, for example, over the currency, it's almost a, not exactly, but in a sense, it's a kind of a forced mandate overall on the currency. So
Right.
it's a very interesting perspective. There's a note that he had referred to in the post, but yeah, it's very interesting to think about how governments would use taxation as an enforcement mechanism to
Mhm.
kind of instill trust in the currency.
That's true. Because then if they don't accept tax in any form of currency but the currency that they can print, then you can't just abandon the system. Like if
Bingo,
right.
exactly.
So that makes a lot of sense. Um, Daniel also asked, do you think that Pax G will command a premium because it exists on the blockchain?
So that's a great question. So PaxG is Paxos Gold. It's a cryptocurrency backed by gold in a vault. My understanding is it goes through routine audits on the actual holdings and reserves. So in the sense of there being a premium, I think that I don't think we'd see a premium. And I'll say it for two reasons. All the while, Pax Gold is awesome because if you take, for example, someone like we were talking about in a crisis of hyperinflation like Venezuela, if someone can have a wallet, in this case, a crypto wallet, and access purchasing Pax Gold through a decentralized exchange of some sort, that's great because now they can have their wealth now in a digitized form of gold that has a real gold backing in a vault somewhere. That's phenomenal. Whereas they originally couldn't possibly maybe access it in person. So that access is really great. But that being realized as well, you're also trusting that for each token that there is some gold reserve somewhere. So whereas if I have it tangibly in my hand, I know I have it. If it's in a vault somewhere, I'm trusting in something. So I don't think there's going to be a premium, even though it's on the blockchain per se, because again, Paxos has the ability to mint more Pax G in this case or less, depending on the reserves. So we have to trust in this case the audit that they go through. So I wouldn't see a premium, to be honest.
Gotcha. Okay. Thank you. Dimitri says, hello, Nicholas. I have been a long-term fan of yours ever since 2017. As an individual educated in financials, my main question is what type of asset class you see as the hedge once the inflation will backfire on certain assets such as equities, real estate, and crypto, as we know cycle will end with such effects of assets cool down. And how long would you keep your cash position extended once actual crash across the markets occurred?
Yeah, it's a great.
Without offering financial advice.
Very good point. Yeah, and I appreciate the kind remarks. I just basically to this point, like the ideal situation is no assets. Look, I would say that I don't think assets are in their current state right now. Things are going to continue this way for I think some time. This kind of inflationary pressure and everything. We're better to follow history and see that it generally doesn't end, right? So being exposed to some degree of your portfolio and assets to hedge yourself in that case, a hyperinflationary situation, I think it's always good having some exposure to assets, just like you should always have some exposure to dollars. But as we move into that environment where the Fed, or other central banks raise interest rates, they stop money printing, making a larger portion of your outlook, your portfolio into cash, expanding that to whatever degree you want, but making it a majority position, if not a vast majority, I think is the ultimate step. There's really not going to be any asset that's going to be saved once people start to regain trust in central banks and they start to monetize their debt and take the necessary precautions to be able to regain the general public trust, right? So I would say no assets. It's still, I would say crypto is probably the best, even though it will probably correct the hardest. It will eventually grow back to its original valuation, in my opinion, comparative to equities and all these other ones, because crypto has more market to scale, it has the ability to grow more long-term than any other asset class, pretty much due to its size and its value proposition. as an asset and the ability to appreciate in value. But yeah, I would say generally speaking, when that time comes, rush back to cash for a little while, but still have some asset exposure. You don't want to find yourself in a position where you're all back in cash and that people really haven't regained trust in the system. At that point, it might be the S curve where people are looking for a new technology, looking for a new system to store their wealth.
Mm-hmm. Yeah. So when things go down in value, isn't the general rule I've always been taught for investing. Obviously, it's not financial advice, but is to, number one, never invest more than you're willing to lose, and two, always just be able to cancel out the noise, the ups and downs, and just have, if it's a good asset, it's going to go up in the long term, but it's not going to go smooth. It's going to do that. So you have to be able to have a long-term perspective and not just like, I have friends that sometimes that happens to them. They're like, it's down, and I'm like, oh, it's okay, it'll go back up. You have to have a long-term perspective, unless you're day trading, and in which case your goals are a lot different. But
yes, we generally, even though it is still not financial advice, I will say, statistically speaking, day traders in traditional markets like Forex and equities lose money 95% of the time. And in crypto, you might be able to make money day trading. I think that number would probably be a little bit lower, probably more like 50, 75%. But even if you can make money day trading, statistically speaking, you're not going to be able to outpace just passively investing. This is why we love Get Paid in Crypto, which allows you to streamline dollar cost averaging, because you will beat out the market 88% of the time, 88% of market participants, by simply just averaging in to the established players. And this is a really interesting metric that I'm fascinated by personally. But yeah, look, I think overall, as you mentioned, Hope, in those kind of volatile times for assets, you always have to remember, like, okay, what am I really investing in here? Am I just investing to see it appreciate in price? Or am I investing in the fact that this is a time-tested asset that generally, as history continues to repeat, it's continuing to grow over time? So yeah, I think that's a great mindset to have.
Mm-hmm. We're going to ask one more question because we are about 10-15 minutes over time at the moment, and it's like midnight where Nick is. So every time you do this, I always feel like I have to say thank you for staying up super late.
No, it's no worries. I appreciate you staying on, Hope, and also as well for everyone joining. It's always a good, productive conversation.
For sure. So one last question again from Daniel. I thought it was a very interesting question, so I thought it'd be cool to end on it. My friend is making fun of me for allocating into USDC on Celsius for the 10% yield instead of dumping everything into Bitcoin for a 200% return. So what should I tell him?
I think I know it's very difficult to make an argument when you see, like, when people can make the case, oh, Bitcoin's done this and Bitcoin's done that. And look, as you all know, whether you've watched me on the Data Dash channel or you've been a fan of DigiFox and what we've built, we're very bullish on crypto. We think crypto is going to continue to grow exponentially over the next couple of years, outpace any other asset class. I think I've said it enough in this video or in this discussion. But outside of that, as we talked about earlier, your friend in this case, who's 100% Bitcoin, is going to be winning great over the next coming months. But when the bear market comes around, he isn't going to be feeling too good. And he's going to probably wish, especially if he's got recurring expenditures, that he had some dollar exposure. And this is why, again, we're big fans of USDC and the yield generator opportunity, because it allows you to have dollars, something that's relatively stable and predictable, be able to get that yield at the same time. That's still much better than banks, and can now actually, it's a yield that's good enough to hedge you against even the exacerbated levels of inflation we're in right now. I think that it's difficult to make a case for it because you can always say, oh, look, if you would have just invested in Bitcoin, you can always talk in hindsight. But I think it's making sure that you have all of your eggs not in one basket, but in a diverse portfolio of allocations. So and it's the same as well. Like, people would argue, you want to own property, you want to own gold and silver, some exposure to stocks. I'm completely in that ball camp. I've got some exposure to stocks and cash. Yeah. So I hope we talk about that a lot, of like not putting your eggs all in one basket and having some decent exposure everywhere. I think that's the balanced way to go about it.
Mm-hmm. Yeah, just not putting all, yeah, like you said, not all your eggs in one basket, diversify. We don't preach at Digifox to just put 100% of your funds into USDC. We also don't offer financial advice, but it's general, like, common practice to diversify. So, he might want to put everything into Bitcoin, but like what Nick said, eventually it's going to be a point where you're going to need US dollars, and it's better to have them in an asset that's going to gain yield versus just like in a bank account earning like 0.6% interest or something like that. So
exactly.
We are way off time now, so about 15 minutes over. So we're gonna cut it off now. So if you guys haven't had your questions answered, I am going to actually just drop an email into the chat. It's client.success@digifox.finance. And if you email us there, I monitor that email, so it goes to me. It's a relatively new email. But if you will email us there any questions that we didn't get to answer here, I will send them on over to Eugene, and he will compile a list of them to see like what topics are the most popular. So we can do more videos on them, more webinars on these different topics or subtopics that you guys are interested in. So feel free to email us there if you have questions that we didn't answer. Definitely want to get to those if we can. If you have any questions for our client success team in general, you can always reach us on the website at digifox.finance, or in the app in the contact us page on the profile tabs. The very right hand bottom corner, the little person, if you click on it, it says contact support, and you can contact us there. We'll have another webinar next month, topic to be determined, and probably we'll have Nick back on again. But until then, thank you guys all so much for joining. Nick, thank you again so much for being here and for answering questions and staying over the time. Hope you guys have a wonderful Thanksgiving if you celebrate Thanksgiving next week. And we'll see you guys in the next webinar.
Take care, everyone. Thanks so much, guys.
Bye, guys.